There's a whisper in the wind, a siren song promising swift riches, a narrative painted with images of screens glowing in the dark, fortunes made in moments. It's the seductive allure of day trading, often glorified as the ultimate path to financial freedom, a quick escape from the slow, deliberate climb of traditional investing. But what if this fast lane, this chase for fleeting gains, is actually a treadmill designed to exhaust, to subtly drain your very essence, not just your capital? Benjamin Graham, the quiet sage, offered us a profound metaphor. Mr. Market, imagine him as your business partner, always there, knocking on your door daily, offering to buy your shares or sell you his. Sometimes he's jubilant, brimming with irrational optimism, shouting inflated prices. Other times he's melancholic, consumed by fear, practically giving away treasures. The intelligent investor, Graham taught us, treats Mr. Market not as a master to be obeyed, but as a servant whose mood swings can be exploited for long-term gain or wisely ignored. The day trader, however, attempts a different dance. Instead of understanding Mr. Market's underlying value, they try to outrun his every whim, to predict his next fit of emotion. It's a relentless sprint against an unpredictable force, a constant battle against the very nature of human psychology and market mechanics. Today, we step away from the dazzling lights of rapid transactions and the adrenaline of quick wins. We will peel back the layers, not to teach you how to trade, but to understand why so many find their capital eroding silently, almost invisibly, in the pursuit of daily gains. This journey isn't about judgment or quick fixes. It's about clarity, about uncovering the hidden truths behind the market's intricate dance, and empowering you to make decisions rooted in deep understanding, not fleeting hope. We're asking, beyond the headlines, what's really driving the market, and how does that truth challenge the rapid-fire world of day trading? Is your diversified portfolio truly diversified, or are you chasing shadows in the market's daily ebb and flow? We're uncovering the hidden truths behind wealth accumulation, truths that often lie patiently beneath the surface, far from the frantic pace of the trading floor. Don't just invest, understand the why behind every decision. Challenge the consensus. Find your edge. Have you ever felt that quiet frustration, the whisper of doubt when a trade you thought was profitable somehow yields less than expected? This feeling of being constantly behind, this investment inadequacy, often stems from an invisible tax embedded deep within the market's structure, the bid-ask spread and slippage. These are the silent siphons, draining capital before you even realize a gain. The common distortion is believing the price on your screen is your immutable price. But the market isn't a single point, it's a dynamic order book. The bid price is what buyers offer, the ask is what sellers demand. The gap, the bid-ask spread, is a persistent cost. When you buy, you pay the ask. When you sell, you get the bid. Then there's slippage, where your execution price deviates from your expectation, especially in volatile moments. To truly grasp their impact, one can calculate the average effective spread, estimate cumulative slippage, and project these costs over hundreds of trades. The shattered expectation is that market entry and exit are instantaneous and cost neutral. The counterintuitive truth is that every rapid transaction incurs a micro cost. Imagine a day trader executing 50 round-trip trades daily on a stable stock. Even with minimal spreads and slippage, these tiny amounts compound rapidly. Over hundreds of transactions, these seemingly insignificant figures become a substantial drain, silently eroding potential gains and often turning what should be a winning strategy into a losing one. This constant drain is profoundly like an invisible current pulling against a swimmer. Even in calm waters, this unseen force makes forward progress exponentially harder. You might be exerting tremendous effort, only to find yourself struggling just to stay in place, let alone advance. It's the systemic friction designed into the market itself, often overlooked by the ambitious retail trader. Yet it's a powerful force demanding our deepest understanding. There's a deeper cost, one not found on a brokerage statement, but etched into the very fabric of our being. It's the silent, gnawing exhaustion that comes from constant decision-making under pressure, coupled with the subtle sabotage of our own minds. This cognitive and emotional toll, fueled by biases like loss aversion and overconfidence, is a profound unseen cost in the day trading arena. It undermines our ability to critically analyze data and deconstruct market narratives, silently eroding not just capital, but peace of mind. The common distortion is believing that sheer discipline or an iron will can overcome the fundamental neuroemotional wiring that has kept humanity alive for millennia. We often equate mental fortitude with immunity to cognitive pitfalls, ignoring decades of behavioral finance research that illuminates our inherent vulnerabilities. The shattered expectation is that the human brain is an optimal decision-making machine for hyper-short-term market predictions. The counterintuitive truth, however, is that it is fundamentally ill-equipped, wired for survival and quick pattern recognition, often leading to false positives, not the rapid, emotion-suppressing, statistically rigorous demands of the trading floor. Consider loss aversion, the deep-seated human tendency tendency to feel the pain of a loss far more intensely than the pleasure of an equivalent gain. In the rapid-fire world of day trading, this can lead to holding onto losing positions far too long, hoping for a recovery that rarely arrives, and cutting winning trades too soon, fearing their reversal. Then there is overconfidence bias, where a string of successful trades inflates our sense of infallibility, leading to insufficient due diligence on subsequent decisions, dismissing critical signals, and taking on undue risk. This constant internal struggle is the tyranny of the urgent, our brain's reward system. The dopamine rush from perceived wins and the stress response, the cortisol surge from losses, are constantly triggered. This relentless cycle overwhelms the prefrontal cortex, the seat of rational, long-term strategic thinking, making consistent, profitable execution a near impossible task. It's a continuous internal battle that silently drains not just money, but mental clarity and emotional resilience. There's a quiet ache many feel, a philosophical wound that surfaces when we question the very logic of our relentless activity. It's the nagging doubt that constant engagement, the endless pursuit of fleeting market movements, might actually be counterproductive. Despite the immense effort, the hours poured over screens, there can be a profound sense of stagnation, a feeling that time and energy could be far better spent. This is the shadow of opportunity, the unseen cost of what day trading steals from your future. The common myth is that high activity inherently equates to high productivity or superior returns. This distortion suggests that constant market engagement is a prerequisite for financial success rather than a potential hindrance. It ignores the quiet, almost magical power of compounding and the profound wisdom of strategic capital allocation. The shattered expectation is that day trading provides a faster path to wealth. The counterintuitive truth, however, is that its true cost isn't just the capital that might be lost, but the lost potential asterisk of compounding that same capital within strategically sound, long-term investments. It's an unseen opportunity cost, systematically eroding future wealth before it ever has a chance to blossom. Imagine the profound difference over 10 or 20 years between a modest, diversified long-term portfolio built on the patient principles Benjamin Graham taught us, allowing capital to grow through time and intrinsic value, versus a day trading account. In the latter, even with marginal theoretical gains, the constant transactional costs, the bid-ask spreads, the slippage, and the emotional volatility systematically chip away at the very foundation of growth. These frictions prevent the compounding engine from ever truly gaining momentum. Day trading, in this light, is like leaving the compounding engine idling. Your most powerful wealth-building tool, capable of exponential growth through patient, strategic allocation, is left dormant, or worse, consumed by transactional costs and emotional turbulence. Instead of harnessing the market's long-term upward bias, we find ourselves caught in a relentless cycle, missing the profound, quiet power that builds true, sustainable wealth. What wisdom might we gain if we allowed the seeds of our capital to grow, undisturbed by the gentle hand of time? There's a silent, unsettling fear that can creep into the heart of an active investor, the feeling of being consistently outmaneuvered, as if the market knows your moves before you make them. It's a distrust that gnaws at the soul, a sense of investment inadequacy that whispers the game is rigged against the individual. This deeply felt unease arises from facing the algorithmic gauntlet, an unseen cost that makes the day trading arena an increasingly unwinnable game for many. The common distortion is believing that sheer technical analysis, meticulously applied, can provide a consistent edge against the vast resources of institutional players and their high-frequency trading, or HFT, algorithms. This belief ignores the profound technological and informational asymmetry that defines modern market structure. The shattered expectation is that the market is a level playing field where skill alone dictates success. The counterintuitive truth, however, is that it is a high-stakes arena dominated by ultra-fast algorithms and sophisticated market makers who possess sub-millisecond advantages. These systems are often designed to profit precisely from the liquidity that retail traders provide. Consider the mechanics of latency arbitrage, where algorithms exploit tiny price discrepancies across different exchanges faster than any human possibly could, or the subtle art of order book spoofing, where large, non-bona fide orders are placed to trick others into revealing their intentions, only to be cancelled moments later. These strategies, while often operating in a legal grey area or outright illicit, demonstrate how HFTs can effectively front-run retail orders, extracting microscopic profits across millions of trades, subtly manipulating price action. This makes consistent profitability for manual traders a statistical anomaly, not a reasonable expectation. This relentless struggle is akin to playing a chess match against a supercomputer. The human player is always several moves behind, operating with incomplete information, slower processing, and inherent emotional biases. Meanwhile, the opponent possesses perfect information, infinite speed, and no emotion whatsoever. The outcome, statistically speaking, is predetermined for the vast majority. This algorithmic dominance becomes an unseen cost, silently siphoning potential gains and eroding capital, not through bad decisions on your part, but through the very structure of the modern market. There's a deep-seated ache many feel, a profound sense of inadequacy when faced with the competitive financial landscape. We see the stories, the dazzling headlines of day trading winners, and a quiet doubt creeps in, making us question our own ability to make truly informed, independent investment decisions. This often leads to self-blame or, worse, doubling down on flawed strategies. This feeling is a direct consequence of the mirage of mastery, an unseen cost fueled by survivorship bias and the false profits of day trading. The common myth surrounding active management and individual trading success arises from focusing solely on these visible winners, completely ignoring the vast graveyard of unseen failures. This is a classic case of survivorship bias, a distortion that profoundly skews our perception of the true probability of success in highly speculative endeavors. The shattered expectation is that consistent day trading success is a common, replicable outcome. The counterintuitive truth, however, is that the successful day traders are often statistical outliers, amplified by social media and anecdotal evidence. Meanwhile, the systemic failure rate, which often hovers between 80% and 90%, remains largely obscured, creating an unconscious cognitive bias that subtly influences our investment decisions. To truly discern genuine skill from mere statistical noise and the pervasive influence of survivorship bias in financial narratives, we must employ a three-step technique. First, demand verifiable, long-term audited track records, not just fleeting screenshots of profit and loss. Second, endeavor to analyze the entire universe of participants, not just the fortunate few who manage to last. Third, deconstruct the advice offered for its underlying principles, checking for alignment with time-tested investment philosophies rather than simply chasing hot tips. This phenomenon is profoundly like a selective spotlight, illuminating only the few who made it across a treacherous chasm, often for reasons beyond pure skill. Countless others, however, fell unseen into the abyss of lost capital and broken financial dreams. This selective focus distorts the reality of risk and reward, creating a false aspirational target that can lead us down a path of financial erosion. What quiet wisdom might we find if we turned our gaze from the spotlight to the shadows, understanding the full landscape of outcomes? We have journeyed through the subtle currents and hidden depths of the market, uncovering the unseen forces that can silently erode capital and dreams. We've witnessed the silent siphon of bid-ask spreads and slippage, a persistent, invisible tax on rapid transactions. We've peered into the behavioral abyss, recognizing how our own minds, with their inherent biases, can become the most formidable unseen cost. We've felt the shadow of opportunity, understanding that true wealth is often sacrificed at the altar of fleeting gains. We've confronted the algorithmic gauntlet, realizing the profound asymmetry faced by the individual against the market's ultra-fast, emotionless machines. And finally, we've navigated the mirage of mastery, dispelling the illusions of survivorship bias and the false profits that lead many astray. Sustainable wealth, the kind that endures and grows like a deep-rooted tree, is not built on the shifting sands of high-frequency speculation. It is forged through strategic, data-driven decisions, a patient, almost reverent understanding of intrinsic value, and the quiet, compounding magic of time. It demands a different kind of engagement, one that seeks clarity over speed, wisdom over impulse. Warren Buffett, a shepherd of patient capital, offered us a guiding star. Rule no. 1. Never lose money. Rule no. 2. Never forget rule no. 1. This isn't a call to inaction, but a profound invitation to protect your capital with unwavering vigilance. Day trading, with its systemic unseen costs and psychological traps, often inherently violates this core tenet, systematically eroding capital before true growth can even begin. It's like trying to fill a bucket with a hole in the bottom. No matter how much water you pour, the unseen leak prevents it from ever truly filling. Perhaps it is time to step back from the frantic pace, to critically reevaluate our approach to these vast, living markets, to shift our gaze from the speculative, short-term gamble to the informed, long-term investment, anchored in fundamental analysis and a disciplined, strategic framework. It is a call to align your actions not with the fleeting whispers of instant gratification, but with the deep, resonant truths of enduring value. What quiet wisdom might you uncover? What enduring wealth might you cultivate if you chose to listen not to the market's daily shouts, but to its timeless, patient songs?